All right, welcome back, everyone. Listen, by the end of this explainer, you are going to understand CoreWeave's massive structural margin inflection. We're also going to break down exactly why AI compute is rapidly shifting from a one-time cost to a compounding utility. And the best part? I'm saving you 2 solid hours of parsing through their raw, dense earnings call. We are looking at a company here that is fundamentally rewriting the entire playbook on AI infrastructure. And honestly, the Q2 2026 numbers they just dropped, they are genuinely eye-opening. Let's get into it. Okay, here's a quick blueprint of what we're hitting today. Section 1 is structural margin inflection. Section 2, the continuous AI loop. Section 3, monetizing older GPU fleets. Section 4 covers securing massive power capacity. And finally, Section 5, heavy debt and J-curve risks. We're skipping the fluff and diving straight into the high-signal takeaways.
Okay, let's dive right into Section 1, Structural Margin Inflection.
The absolute biggest takeaway from this whole report is that CoreWeave's operating leverage, it's finally kicking in. We aren't just talking about basic revenue growth anymore. We are seeing a real structural inflection point where their profit margins are actually expanding as they scale. Get this, $104 billion. That is their revenue backlog right now. It's up a staggering 246% year over year. But you know what's wilder? That figure doesn't even include the $25 billion in net new commitments they locked down just weeks before the call. Plus, over 50% of this backlog is already being delivered and recognized as revenue today. The visibility they have into their future cash flows is, well, it's pretty much unprecedented in the cloud space.
When you dig into the core financials, you can see exactly how this massive scale is playing out. Revenue hit $2.6 billion, which is up 112% year over year. Adjusted EBITDA came in at $1.5 billion. That gives them an incredible 59% margin. But actually, the real star of the show here is the adjusted operating income of $128 million. This completely crushed management's own official guidance ceilings. What this proves is that as their infrastructure base grows, all those massive, heavy, early ramp-up costs are finally getting diluted. It leaves them with a 5% operating margin right now, and that's expected to climb into the low teens by the end of the year.
Now, you might be wondering, how exactly are they commanding these kinds of margins? Well, according to an independent evaluation by Signal65, CoreWeave's total cost of ownership is actually 47% lower than your typical hyperscalers, think AWS or Azure. Because CoreWeave offers this integrated, software-defined, AI-native cloud setup, rather than just bare metal, they have immense pricing power. In fact, this advantage is so rock solid that they literally raised their prices across all SKUs by about 25% back in July to offset some rise in component costs. And guess what? They didn't lose a single drop of demand. Raising prices by a quarter and keeping your entire customer base, yeah, for sure, that is a massive flex.
Moving right along to Section 2, the continuous AI loop. Let's unpack CEO Mike Intrater's core thesis on where this market is heading. He pointed out a fundamental shift in the basic economics of AI compute. We're moving away from what used to be a deploy and forget model. Instead, we now have what he calls the continuous AI loop. Think about it. An enterprise doesn't just train an AI model once and call it a day anymore. That's just not how it works. They train it, push it to inference, evaluate its real-world performance, re-optimize the model, and then redeploy it. It's a single, uninterrupted, compounding cycle of continuous improvement.
So why does this matter for us as investors? It changes the whole game. AI compute is no longer viewed by these businesses as an early-stage one-time capital expenditure. Instead, it's shifted into a daily, compounding operational necessity. For CoreWeave, this translates directly into incredibly sticky, recurring, and expanding revenue streams. It totally insulates them from the wild volatility of those one-off hardware purchase cycles.
And you can see this continuous loop capturing demand across the entire economy. Actually, scratch that. It's not just tech startups in Silicon Valley anymore. CoreWeave is bringing on massive, top-tier clients from everywhere. You've got Caterpillar using them to train physical AI for autonomous construction equipment. Isomorphic Labs is on board for life sciences research. There's Flow Traders in IMC and quant finance, Leidos handling national security, and even frontier tech partnerships with Descartes and IBM. This proves their high-margin compute is driving actual real-world monetization across wildly different sectors.
Okay, before we get into what was easily the most surprising part of this entire earnings call, I have a quick request. If you want to stay updated on the latest US stock market news, make sure to subscribe to my channel. I upload new explainers every week, cutting right through the noise to bring you the high-signal takeaways.
All right, Section 3, monetizing older GPU fleets.
This was the absolute mic drop moment of the Q2 report, and it totally shatters a major myth about the AI hardware cycle. There's this widespread market assumption that because AI chips iterate so insanely fast, a 3-year-old GPU is basically an obsolete brick that needs to be written off. But the CoreWeave reality, it's completely different. Because of the massive compute shortage we're seeing, fully depreciated older generation chips are basically printing money right now. CoreWeave just signed a whole fleet of older 2020-era A100 GPUs to high-pricing long-term renewals that stretch all the way out to 2029. No joke.
These older chips are the perfect unleveraged fuel for inference, which, if you remember, just means running the AI models once they're actually built. CoreWeave's managed inference platform has seen its annual recurring revenue absolutely explode. We're talking going from just $1 million to over $100 million in a matter of months. And they are targeting $250 million by late 2026. The beauty here is that customers pay by the token, so there are no massive take-or-pay commitments for the client, but it creates incredibly high profit margins for CoreWeave on hardware that's already entirely paid off.
Okay, moving to Section 4, securing massive power capacity. We really have to address the elephant in the room for any AI infrastructure play right now, and that's grid capacity. Compute requires electricity, plain and simple. And CoreWeave is executing an incredibly aggressive land grab for power. At the end of Q2, they hit 1.5 gigawatts of active power. Looking just slightly ahead into mid-2026, they've already secured line of sight to roughly 6 gigawatts. And their target for the end of 2030, an astonishing 8 gigawatts minimum. This is being pushed forward by a massive new 360 megawatt contract in Indonesia, which officially marks their entry into the Asia-Pacific market. Now, what's really interesting about their approach is how they handle local pushback. When analysts brought up worries about NIMBYism, the whole not in my backyard movement pushing for data center moratoriums, CEO Mike Intrator was super blunt. He just said, moratoriums won't reduce AI demand. They just dictate where infrastructure is built.
To make sure they don't get permanently blocked by local regulators, CoreWeave uses a really smart, collaborative operational playbook. When they enter a new community, they don't just hook up and drain the power grid. They actually directly fund the local grid upgrades right out of their own pocket. This ensures that electricity rates do not go up for the everyday residents living there. By paying for that infrastructure themselves and creating high-paying tech and construction jobs, they essentially turn potential local resistance into municipal partnerships. It's a brilliant move that keeps that 8-gigawatt target well on track. All right, reality check time. Section 5, heavy debt and J-curve risks. As exciting as all this growth is, building the future of AI compute requires walking a highly asset-heavy tightrope. There is a classic J-curve effect happening here. While they posted $1.5 billion in adjusted EBITDA, when you look at the bottom line, it completely inverts into a massive $626 million GAAP net loss. How does that happen? Well, it's all about timing and scale. They have to spend billions upfront to actually build the data centers before they can turn the machines on and recognize a single dollar of revenue. So, the absolutely crucial thing to understand here is the sheer scale of their borrowing. Listen to these financial drag numbers. In a single quarter, their capex was $9.4 billion. On top of that, they have another $11.9 billion sitting in construction in progress. To fund all this, they had to pay $640 million just in interest expense this quarter alone. And management warns that interest expense could hit $940 million next quarter. That is a severe jump. They recently had to raise $18 billion across debt and equity, which brings their total financing to $32 billion. All of this just to fund a staggering $35 billion annual capex budget.
Naturally, this leaves us with 3 severe risks. First, they have an extreme reliance on continuous access to debt and credit markets. If those credit markets freeze up, CoreWeave's expansion completely halts. Second, these short-term GAAP net losses are going to remain severe for several more quarters while they build out the grid. And third, they have a massive bottleneck risk with NVIDIA and TSMC. If there's any shortage in rare metals or CoWoS advanced packaging, which is the highly complex process used to assemble these chips, CoreWeave simply can't deliver the servers. And if that happens, that beautiful $104 billion backlog stalls out entirely.
CoreWeave is executing at a scale that is honestly hard to even comprehend, but they are absolutely walking a financial tightrope to pull it off. So I want to hear from you. Question 1. Do you think CoreWeave can successfully manage this massive debt load to actually hit their 8-gigawatt goal by 2030? And question 2, which U.S. stock or company's earnings should we unpack next? Let me know down in the comments. Thank you so much for your time, focused learners. I really hope this explainer saved you a couple of hours of reading today. I'll see you in the next one.